So financial models uh, allow us to do projections. So we can, we can look at a new project, and based on our prior experiences, we can forecast the the revenues and expenditures for that project. So when we're looking at investment in new assets, that's a capital budgeting decision. Um, the degree of financial lever, there's the capital structure decision. Cash paid to shareholders, dividend policy decisions. So we've talked a lot about the dividend policy. The and well the whether to pay out or not pay out dividends, and it's important to remember that if paying out dividends when the company has projects that will generate returns above the cost of capital, those that would actually decrease the value of the firm. Vice versa, then not paying out dividends when and to accept an inferior project or a project with a return below the company's cost of capital would also reduce the value of the firm. Liquidity requirements determined by net working capital decisions. So financial planning involves sales forecasts, cash flows, many cash flows, expenses, so forth, depend on the level of sales. They often use them to estimate a sales growth rate. Pro forma statements, set up a plan as projected. Pro forma to create financial statements based on historical expenses, so forth. Asset requirements, additional assets that you use to produce the goods necessary for increased sales projections, for example. Financial requirements, the financing needed, to pay for required assets, or the debt to equity decision. Plug variable is just it's something management uses to determine which type of financing you use, to make the balance sheet balance. Also have economics assumptions. You use those to analyze or to estimate what we think the economy is going to look like at some point in the future. First financial modeling approach is percentage of sales. So the idea is some items don't very directly with sales, others don't. Income statement, costs can very directly with sales, or they may not. So if they do, the profit margin will be constant. Depreciation, interest expense don't vary directly with sales, or may not. If this is the case, profit margin is not constant. Dividends, management is a decision of management. They're likely not to vary directly with sales. Most times companies tend to pay out a similar amount each. Most times they do it quarterly if they're paying dividends. So this will affect your retained earnings, or changes in retained earnings. So about percentage of sales approach. Again, the second part, balance sheet. So see, initially we'll assume that all assets, fixed and variable, vary directly with sales. Accounts payable will vary directly with sales. Notes payable, long-term debt, equity generally do not vary with sales because they depend on management decisions, not necessarily sales. Change in retained earnings, the portion of equity that back from the dividend decision. Then next, external financing needed. So external financing needed. The difference between forecasted increase in assets and the forecasted increases in liability and equities. So, the so external financing needed can calculated as the following. Not sure if this was, I corrected this in this slide. There's an error. This formula wasn't included, but this long formula it's used to calculate the external financing needed. So assets divided by sales, change in sales, spontaneous liabilities, the divided by sales, multiplied by the change in sales minus profit margin, the multiplied by projected sales. Okay, so and then finally multiplied by 1 minus D, with D being the dividend payout ratios. Spontaneous liabilities are liabilities that go up and down with sales. So then below is an actual calculation. If I get there. There we go. This is from the book, the Rosengarten Corporation. So those are all those numbers come from their financials with which are included in chapter 3 in the book. So external financing and growth. The low growth levels, internal financing, retained earnings, may exceed the required investment. But when growth rate increases, internal financing, won't be enough. The firm will have to go outside. To examine the relationship between growth and external financing needed. First way we do that is with the internal growth rate. The internal growth rate tells us how much the firm can grow assets using retained earnings as the only source of financing. So this is Hoffman Company's information. So they have a ROA of 13.2%. So plowback ratio, then we'll see a formula here shortly. The plowback ratio, or B is the symbol used for that. That's the 66.67%, or remember that the dividend payout ratio was 0.333. Then so internal growth rate is the ROA times the plowback ratio divided by 1 minus the ROA time multiplied by the plowback ratio. Plug those in and get an internal growth rate of 9.65%. So without any external financing, the company can grow at a rate of 9.65%. So the next is a sustainable growth rate. Sustainable growth rate tells us how much the firm can grow by using both internally generated funds and issuing debt to maintain a constant debt ratio. So go back to the Hoffman Company. So the only difference between the two formulas is we're going to use ROA. We're going to use ROE instead of ROA here. So the Hoffman Company's ROE was 0.264 or 26.4%. And remember the plowback ratio was 0.667. Go down, and so sustainable growth rate for the Hoffman Company, ROE times the plowback ratio, divided by 1 minus the ROE times the plowback ratio. Plug those in um, and solve the equation. You get a sustainable growth rate of 21.36%. So if the company continually grows and maintains its debt ratio, it should be able to sustain a 21.36% growth rate. We'll start the next lecture with determinants of growth.